This is The Weekly on ClickOrlando.com with Justin Warmoth.
Good morning, I'm Justin Warmoth. From Wall Street to Main Street, 2022 was a rough economic year. The Federal Reserve hiking interest rates to tame historic inflation, one of the reasons the stock market had its worst year since the 2008 financial crisis. So the question now, will things improve this year? This morning, the stock doctor Lee Siler is here to break down his 2023 forecast and the uncertainty that lies ahead. Lee, great to see you again.
Hey, good to see you, Justin.
Happy New Year.
Happy New Year to you and your family.
I don't know if the statute of limitations is passed, but I'm going to say it anyway.
It's close enough.
Close enough, absolutely. Yeah. All right, so let's get into it. It was a rough year, there's no doubt. 2022 was a rough year in the markets. Worst year for stocks since the 2008 financial crisis. Yeah. Let's look back at that before we go ahead. Your take on what happened in 2022, and then from there, let's go ahead to 2023.
Well, keep in mind, first of all, the market doesn't go up every year. In fact, the market goes up 72% of the time, so 28% of the time it goes down. So let's just say 1 out of every 4 years the market goes down. That was 2022. It could have been much worse because there's nothing but bad news out there. But to make matters a little bit worse, not only was the stock market down, but a lot of folks who are in retirement or close to retirement invest in bonds because that's low volatility. That's the safe money. But even bonds were down. By the way, worst year in history for bonds, not just 100 years. In history, they were down 15% on average. That's your safe money.
That is the safe money. So where should that safe money go as we look ahead to 2023?
Well, I think last year was kind of an anomaly because the Fed normally is not this aggressive in raising rates because there's an inverse effect when you invest in bonds. So as rates go up, the price of bonds go down. So the Fed raised an equivalent, because normally they raise 1/4 of a point per meeting. They've raised an equivalent of 17 times. 17 times in 9 months. That's extremely aggressive. Prices got out of whack in the bond market. Investors, then you start selling, not to mention quantitative tightening, which the Fed was selling their own bonds, government bonds, at $95 billion a clip on a monthly basis. So they were actually buyers. We were the biggest buyers of our bonds that kept yields down and prices up. So that changed things. Look, the bottom line is if you save money, bonds are probably a decent place right now because now you can get yields. When's the last time you saw CDs at 3.5%, 4%? Haven't seen them in 20 years.
Yeah. Well, I think the Fed, I think everyone expected rates to go up. I mean,
Sure.
it had to happen. It had to happen. But towards the end of the year, and you see that same aggressive nature, your take on that, and did they go too far? Have they gone too far? Because I don't think they're necessarily done, and I think you can point more to that.
Based on history, the Fed always goes too far. I was looking and reading yesterday on the history of rate hikes, and there's many times that the Fed has been aggressive, certainly not this aggressive. 17 times it's happened before, but not in this time frame. They did 4 75 basis points or 3/4 point hikes in a row. 4 before they went to 50, and now it looks like in February, March, we don't know if it's 50 or 25, but it's going to be at least 25. And the Fed is going to slow their pace down, so that's good. And at some point this year, because it does take sometimes 2 years for Fed hikes to get through the economic system. So we're already seeing inflation come down. We're seeing the housing market, which one of their elements that they wanted to really take care of. We're going to start seeing unemployment rise. This is what they want. And we talked about this before we went on the air, Justin. This is not your vanilla type organic economic meltdown. This is a Fed-induced recession that they had to do because the Fed didn't do their job and kept using the term transitory, which means temporary, when they were talking about inflation. It wasn't temporary. It wasn't transitory. In fact, it really hurt a lot of people, so they got very aggressive. And when the Fed gets aggressive, the term they use is hawkish. So at some point, the Fed's going to use one of the 2 P words. They're going to either pause or they're going to pivot, or pause and pivot. Once that happens, I think we get the all clear. The first 6 months of this year probably going to be rough for the market. But I mentioned this earlier in our conversation that it's highly unlikely, based on history, that the stock market goes down 2 years in a row. In fact, it's only happened 4 times in history, and each one of those times was a huge financial crisis. We're talking the 29 crash, the 71 to 73 meltdown, the 2000 and the 08, 09. So it's highly unlikely we go down 2 years in a row, but the first 6 months may be a little bit rough.
To be clear, what is the Fed looking for to pause? And I know we talked about, taming inflation. That has happened. Is it the jobs market that is what is continuing this push, this aggressive push? What is it that they're looking for to maybe hit the pause button?
It's a domino effect because as job loss occurs, less people spend money. Their target for inflation is 2%. I think that's almost impossible because what's been going on around our country is minimum wage going up, the cost of things as far as labor. I think where labor inflation is here to stay. So I think to get down to 2% is highly unlikely. If we get down to 3%, I think we'll get lucky. So I think they're going to change their expectations and say, you know what, this is not 2010, 2015, we can do 2% inflation. I think we have to learn to live with 2.5% or 3% inflation.
I know when we talked in September, you felt that we were already in a mild recession, correct?
Yeah, I mean, the yield curve tells us that, which was inverted, and that's a whole technical term we talk about another time. And then you had the 2 quarters of negative GDP. Since then, we've had positive quarters. But keep in mind, there's an organization called the NEBR. They determine whether we're in recession or not. And they always look through the rearview mirror, so they'll go 6-9 months from now and say, oh, by the way, Q1, Q2, we were in recession, which I think you and I can do just the same job.
So, but that's what you expect to happen.
Yeah, and look, if it's not recession in the first half of 2022, certainly I think we're in for a mild recession because usually, again, the Fed hardly ever gets it right.
Interesting. As when people hear recession, obviously, it sends chills up their spine.
Sure.
Whether that has any real effect on their bank accounts, their 401ks, what have you. But when we talk about a recession, what do you expect? I mean, if we do, when we do, I don't know, whatever. Is it mild? Is it shallow? What's the weight that it could have?
Well, I think it's first and foremost, people's concern is job security.
Yeah.
I mean, that's what really you're concerned about. Hey, if you have your job and your wife has her job, you're not so worried about recession. What really is hurting you is inflation.
Yeah.
So the folks that have job security, they're not so worried about losing their job. They're worried about getting inflation down. So what the Fed's going to do is they're going to create job loss because this is what they do. Because we are at 3.7% unemployment. They hope to get it over 4%. Back in the day, full employment was 5% unemployment. So, we're a far cry from that. So the Fed wants to get job loss. We're seeing that. Salesforce.com, a Dow component, laying off 10% of their workforce. We've seen many technology companies now starting to lay off, and we're starting to see job loss. So that's what the Fed's going to do because they believe it starts with job loss, and they already kind of crushed the housing market short term as far as sales, not pricing yet, but sales are down significantly because 6.5%-7% mortgages.
Yeah, absolutely. I mean, do you think that the housing market is in its own recession currently?
Probably, as far as sales.
Yeah.
The prices haven't gone down that much,
Right.
but if you look at some of the sites like Realtor.com, you'll see price reductions all over the place.
Nothing is selling for 50, 60, 70,000
No.
over asking.
You're not seeing that now. And
Yeah.
plus, keep in mind, 65% of homeowners have mortgages on their house. So the supply of housing, I don't see that going up that dramatically because if you have a mortgage at 3.5%, and you need a mortgage to buy or upgrade to buy another house, you're highly unlikely going to trade and get a mortgage at 6.5% because you're just taking yourself out of the market.
And when home prices soar, rent follows suit. Coming up, Siler will give his take on whether prices could stabilize, plus his advice on how those with 401ks should navigate this choppy market.
This is The Weekly on ClickOrlando.com with Justin Warmoth.
Welcome back. Even though several headwinds remain, experts are hopeful the stock market will rebound after suffering its worst year since 2008. The Federal Reserve has been aggressively raising interest rates as it works to get inflation under control. It's been working so far, but the price for shelter continues to surge. The stock doctor Lee Siler is back with us now to explain whether he believes rent prices could stabilize in 2023. So many people are wondering what will happen with my rent this year. Could it perhaps remain stagnant? I don't want to have to pay another 10%, 15% more than I'm paying this year.
Well, unfortunately, rents lag behind prices. So it just takes time because think what people do. They sign 12-month leases. So pricing can go down quickly. I mean, we've seen a decline in some prices, but keep in mind what happened the first quarter of 2022. We saw ridiculous buy prices on homes. People, like you said, 30, 40, 50,000 above asking for the moderate price homes because money was cheap and there was just a frenzy. People had to have housing. We still have a housing shortage. So the home builders will still have to build, but the existing home sellers, that is more where the problem I think lies as far as valuations, because again, nobody's going to leave their house if you need a mortgage, and that 35% of the population that could pay cash, it doesn't matter to them. They're going to go out and find a deal somewhere.
Your clients, what are their main questions that they have been asking you as you look ahead to 2023? What are their concerns? What are their questions? How is their optimism as they look ahead?
Oh, they have no optimism.
Yeah.
Everybody's pessimistic. And actually, that's a good thing, because you can't talk, and anybody says, oh, we were up this year to 2022. Nobody was up. You know, the key is we try to not go down as much in years like this, because we know, again, going back to rarely is 2 years in a row are down. So let's regroup. Let's take a look at our positions. You reallocate, look at sectors you think will do better, maybe add some protection in the portfolio. There's ways to do that. But energy worked last year. It's likely it's going to work again this year. Healthcare probably going to work this year, which is fairly recession-proof. And then you got to look at some other segments of the economy. Are financials going to be okay? Because they do better in rising rates. And how long rates are going to stay this high. The likelihood is we're going to be higher for longer than we have in the past. But I do believe the Fed funds will probably be cut maybe by Q4, sometime in that quarter. You'll see the Fed saying, okay, I think we've done enough. Let's cut 25 or 50 basis points. Just put the brake down just a little bit.
I think the majority of our viewers have 401ks. If they're investing, that's likely how they invest.
Right.
But let's just say, hypothetically speaking, that someone has some cash that they're sitting on, that they're waiting on. Is there it's impossible to time the market as you want to. Let's talk about that. It's not timing the market, it's time in the markets.
Exactly. And one thing you have to look at, you can invest in the S&P 500 for one day and have a 53% chance of making money in one day. That's Vegas. Okay, but if you can hold on for 3, 5, and 10 years, your odds go to 87%, 92%, and 97% chance. So even if you're 3, 4, 5 years away from retirement, you still have an 80% to 92% chance you will make money. Now, this is based on the S&P 500. And so what I tell people that have 401ks, and I hear this all the time, well, should I stop putting in my 401k? No. If you can afford it and you have job security, put more in your 401k, because you're buying those mutual funds, which is what normally 401ks have. Right. You're buying those shares at low prices. They're not going to be here a year, 2, 3 from now. So why not put as much money as you can in a tax-deferred investment, lower your tax situation at work, and let it snowball 3, 5 years from now?
Is it best? What's the best practice? Is it head in the sand? You don't want to have completely head in the sand. Maybe an eye out, but
no. But I tell clients, don't look at because now everybody has access on their phone.
Yeah.
All right.
Yeah.
Don't look every day. Don't even look every month if that makes you uncomfortable. Maybe look every quarter, or give us a call at the office and say, hey, so how are we looking? What do we have in the portfolio that maybe can protect us from a black swan event? Because we haven't even talked about that. The pandemic was a black swan event nobody expected. There are some black swan events. We talked about 2022 that there's really no good news. Even the midterm elections didn't go the way the market wanted it to go.
Right.
So, and that was supposed to be one. But there's been no good news, which leads me to believe at some point there's going to be good news, whether it's in Ukraine, whether it's inflation, whether the M2 money supply is getting stronger. By the way, M2 money supply is money people have in their checking accounts, money markets, CDs. That's dropping like a rock. So people have spent that stimulus money, and so now that's a little bit scary. So it looks like, in general, the population is not ready for recession. Those cash reserves are gone.
Yeah, I always like to sort of end on some optimism and some tailwinds for the market,
Sure.
and the good that this tough period will do going forward. What insight do you have on the changing landscape of the economy, not necessarily this year or even next year, but down the road in America, and what the economy is going to be like, and the way we produce goods and do things like that?
Well, look, we live in the greatest country in the world. And we've gone through a little bit of a trying time. I mean, the whole world has, but think of how they handled COVID and how we handled COVID.
Right.
So, I mean, when you read the news, there's nothing good out there. At some point, there will be some good news. And one point I have to just stress to people, if you need the money quickly, if you have money that you're in the stock market that you're going to need a year from now, 6 months from now, it shouldn't be in the stock market. It shouldn't, because you need time. And the bottom line is, we don't know where the next 20% is going to come from. We don't know if we're going up 20% or down 20%. But based on history, we do know where the next 100% is going to come. And that's to the upside. That is history. That's what it tells us. And we have great companies out there that right now they're getting their earnings cut, their price targets cut all across the board. That's usually the signs that a bottom is near.
Yeah.
That's when normally, because remember, the people sell at the bottoms. And right now, I saw a statistic that retail selling is just overwhelming. So it means individual investors are out. They said, you know what, I'm throwing in the towel, I'm done. That's probably a mistake.
Yeah, there are some great buying opportunities. Quickly,
Sure.
give us a few that you like, where they are right now, and how long you would hold them.
Okay, well, I don't know people's personal situation.
Sure.
So I'm just going to tell you right now that I've seen Apple absolutely get destroyed. And reason is that they can't fill iPhone orders that they got in Q4. But let me ask you this question. You have an iPhone, I see.
Yeah.
Okay, so because you can't get the new iPhone 14 this month, are you going to jump to Samsung?
No.
No. Once you're in the Apple ecosystem, you're stuck there. So the stocks dropped from 184 down to 125 literally in no time. I think that's an opportunity.
I'm curious, I know that you expect that we will be higher than we finished this year with the S&P. Let's focus on the S&P.
Okay.
Do you have a price target on how this year will end?
I don't think we're going to be high double digits or anything like that, like 15, 20%. But I do think that from December 31st, we could easily be a just 8 to 10%. So we're looking at maybe 4,200 S&P. We're at 38 and change, somewhere around that number. But is it gonna go via 3,500? It's quite possible, because we could test some lows down there at 3,600. That's very possible, especially with all the price cuts we're seeing. But that's not a bad thing. It just gives you opportunity to buy lower. And quite frankly, I feel way better about the market today in January than I did last year in January, because we're at a much deeper valuation. We're much cheaper. And again, going back to history, this is the third year of a presidential cycle, which after a midterm election, 100% of the time goes up. So that's good. Then I told you about the usually not 2 years in a row. We have a lot of things going for us. It's just a lot of bad news out there. You're a news guy. At some point, the news does get better. You'll have a feel-good story somewhere.
And my thanks to the Stock Doctor for his time this week. For updates and news on the stock market and the economy as a whole, just head to clickorlando.com. I'm Justin Warmoth. Hope you have a great Sunday.